heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we'll get a look at investing in private versus public markets. Karen Fronsky's with us, head of private equity investing over at Fidelity.
And after planning the largest round of layoffs in big tech history, Amazon and Google are now learning how difficult it is to cut jobs in Europe. We'll tell you why.
And how do you get your news? We'll speak to the CEO of Substack as a newsletter publisher just to continue its growth in a tough market for fundraising. But first, let's talk about money markets in the public domain. We're looking at the Nasdaq, currently up 4%. It was underwater earlier. We're seeing a bit of a mood shift as we enter towards the latter half of the trading day. Remember, shortened trading week for many in terms of the equity markets. The FX markets remain open tomorrow on what is known as Good Friday. We take a day off. We see the Nasdaq push higher as people just start to get to grips with where the jobs data is going to be. I'm also looking at what's happening with the stocks. Currently up just about 0.1% at the moment. Chip markets managing to come away from some of their lows yesterday. The 10-year yield, though, still lower. 7th straight day that we're seeing borrowing costs falling for the 10-year debt. Let's look at what's happening in crypto markets, because we're basically still holding near that all-important 28,000 level, Ed. We just don't seem to be able to break through it as the dollar wavers on the day as we look towards that all-important jobs data tomorrow. But dig in on the micro moves at the moment.
Yeah. Two movers that caught my eye. Alphabet parent company Google up 2.5%. The Wall Street Journal reporting that Google is going to implement and integrate generative AI and conversational functionality into search. I think we thought that was coming, but the market moving on that. And Alibaba up 3.5%. A report out of China overnight that Alibaba itself is working on a ChatGPT style generative AI tool. Also had really key data in the private markets. This coming from PitchBook and the Venture Capital Association, that in the first quarter of this year, $37 billion worth of venture-backed deals, but that's the lowest level going back 13 quarters. I think that's fascinating, Caroline. It's backward-looking data, right? But you compare where we are in the private markets right now with how the Nasdaq 100 has started this year, the public markets, and then we think about the performance of some of those funds like Tiger, who are so sort of focused right now on the tech sector.
And it's helping them finally. I mean, when we're in a bull market for the Nasdaq 100, it's going to help a certain number of companies that are committed to the tech space. And let's talk about just that, Ed. Chase Coleman, Tiger Global, staging that comeback in the first quarter is, well, there has been this rally in tech shares. It's helped the firm recoup from last year's pretty mega record losses. For more, let's bring in Bloomberg's Emma Palmer. Set the scene, because they started off 2023 with half the amount of money that they did in 2021.
Yes, it's been a very difficult year for them last year. Their assets fell a ton. They lost 56% in their hedge funds last year. Their long only was even worse. So their focus right now for them is how do they make back investor losses. And so the gain that we've seen in the first quarter, up about 7%, not bad. They do have a ways to go, but I think investors are happy with any recovery and any gain. They will have to make more than 100% gain in order to make investors whole again.
And Emma, what's their track record on that, right? Tiger's been in this game a long time. They've had bad years before. Will they come back? How long is it going to take them?
Yeah, so in the past, if we look at one of their worst years, they were down 26% back in 2008. It took them about 3 years before they were able to make investors whole again. And then about in 2016, they were down again, and it took them just a year to make investors whole. So that's pretty good if you look at being able to rebound and being able to recoup those losses. I think the question is now, the 56% loss from last year is far worse than both of those two previous years. So how long will it take for them to do that again?
And talk to us about Chase Coleman himself. I mean, he doesn't speak often publicly, does very little media, but he was hosting an event, and it seems as though he was pretty bullish still on buying big tech right now.
Yes, so he was speaking at a luncheon for the Boys Club in New York, and he was asked about where he sees opportunity right now, and he says that tech, has been in something of a recession lately, but it looks interesting again that companies are using and incorporating more technology into their businesses, like Amazon, using ChatGPT, and that he thinks he's bullish on FANGs and would suggest buying FANGs. So not unsurprising for a tech-focused firm.
Who's big in Meta, for example.
Who's big in Meta. But interesting to see, how he sees the road ahead for the space that he focuses on.
All right, Bloomberg's Hema Palmer, thank you with that reporting. We should point out as well that Tiger Global declined to comment on the story. Let's turn now to investing in private markets, the difference of what's going on in that space with Karen Fronsky, Fidelity Investments, head of global private equity investments. We brought you the data from what the VC landscape looks in the first 3 months of this year. You look at what's happening with the NASDAQ 100 and private markets. Where's your focus right now? What's your read on the macro picture?
Well, we actually see the macro picture as being something really exciting and opportunistic for Fidelity. I'll echo some of what it sounds like Chase Coleman was saying, which is now is a time for investors to really be opportunistic and find great investment opportunities. The reality is there are 1,400 unicorns globally worth about $5 trillion. There's a lot of great businesses out there for investors to come in and invest. And unlike 2021, we're starting to see a real rationalization in valuations. Some would argue there's still some room to go there. But when you look at the peak of the market in 2021, private market valuations were 3.5 times more expensive than the NASDAQ on average. And you saw some companies raise at 100 times our ARR or even higher than that. And valuations have really rationalized. So great businesses, valuations that are making a lot more sense, and we see a lot of opportunity.
Caroline, I think you and I are trying to get a real global perspective as well, not just which sectors are sort of most interesting right now, but also geographically, debates about China, the Middle East, where there are opportunities, right?
Yeah, I think that's exactly right. And perhaps one that's garnering a little bit of, what should we say, emotion on public forums such as Twitter, Karen. I'm interested in your perspective of global allocation of money right now. Where are the valuations looking the best?
Yeah, it's a great question. The reality is, I think there are great opportunities globally, and it doesn't always come down to just valuation. A lot of what we're really focused on is what's the TAM? What's the total addressable market for a business? And what type of problem is that business solving? And do they have a real durable competitive moat that's durable over time? And of course, we want to make sure the valuation is right and appropriate for that business. But when we look geographically, we see really large addressable markets in regions like India, for example, where we've made some private investments over the last couple of years. China, obviously, we obviously take into account the geopolitical background of China as well, but Europe as well. So we are a global investor, both publicly but also privately. And those are a couple of the regions that we're most excited about. It really comes down to the addressable markets.
A little there, Karen, in China. Because you say you take into consideration geopolitics. How is it affecting the way in which you allocate?
Yeah, I mean, the reality is, risk return, right? And we can't always prognosticate what governments are going to do, especially governments internationally. And so we just take a little bit more of a risk premium when thinking about allocating to regions where there might be a little bit more geopolitical risk that we can't otherwise account for.
And Ed, we're going to have that conversation in depth a little bit later with a key VC. But Ed, what's also interesting, the thing we're always talking about is, okay, we talk about countries, what about sectors? And boy, do we talk about AI a lot right now.
Yeah, I think what's interesting for me, Karen, in particular, is that lots of the most exciting companies are private, and they're staying private for longer. I think I'm right in saying that you invested in SpaceX for the first time back in 2015. That was a long time ago now. How do you play that field where the most attractive companies are staying private?
Well, listen, the beauty of our model at Fidelity is we can invest privately. We can obviously invest publicly. That's clearly in our DNA, and we can be opportunistic in investing in just the absolute best companies out there. I think it's not any secret that we all think the IPO market has been shut. It's been frozen shut for over a year at this point in time. And the private markets have such a strong depth at this point in time, not only in capital, but also quality of investors, that the beauty is that all of these companies can go public when the timing is really right and when the stars align, as opposed to being forced to go public. The other reason why we do this at Fidelity is, as you mentioned, about the number of public companies that are out there have basically halved in the last 25 years. And there are a lot of companies that only exist privately. We don't have access to them publicly. And so it's really strategically important for us to start investing well ahead of their public event.
You've had a lot of great exits, right? I think Facebook, Uber, but less focus on SpaceX. How do you stay focused on the opportunity for them long term? Do you come back in and do later rounds for fear of missing out? Do you worry about the partners that are touted to be going into a name like SpaceX? Saudi is a name that's been discussed. It's a really interesting mindset that you have to go into in an investment like that.
Yeah, listen, SpaceX has continued to execute extremely well. When we look at their Starlink constellation that's up there right now, the focus on Starship coming out hopefully soon, it's a company that's executed incredibly well. And no, we never invest for fear of missing out. We invest when we continue to think there's value for our shareholders in investing more. And those are the underlying core principles that we try to stick to.
We know that there are other areas than space that you're already interested in: data, social, climate tech, but also, of course, AI, machine learning. That's what everyone is seeming to be excited about. But where in the application of AI are you excited about? Have you come to grips with sort of where the money's going to be made?
It's a great question. We are still doing a lot of work on that question specifically. AI has obviously been around for decades, but needless to say, OpenAI and ChatGPT have brought it to the forefront, and it certainly captured the imaginations and the excitement of all of us. And that's a question that we're spending a lot of time and doing a lot of research on, meeting with a lot of companies to understand, where does the value accrete? Is it at the app layer? Is it at the foundational layer? Or is it at the infrastructure layer? Or is it, some combination of the three?
Right.
We certainly don't have the final answer there yet. I don't think many people do, but it's an area where we're spending a lot of time and doing a lot of research.
Karen, quickly, 2022 really hard. You talked about Chase Coleman Tiger. Did you have to change strategy in reaction to 2022?
Listen, our strategy has always had core underpinnings of looking for great companies with a large addressable market that are disrupting something out there in the market, phenomenal management teams. I think what's changed for everybody is the concept of growth at any cost. And not just us, every investor is very, very focused on the ROI on every dollar spent, profitability, or a clear and convincing path to profitability, and really maximizing margins. But our core underlying principles have stayed the same throughout.
Great to have some time with you, Karen. Thank you. Karen Fronsky, Fidelity Investments. Meanwhile, coming up, Google, Amazon, big tech players are learning it isn't so easy to cut headcount in Europe. We'll discuss why next. Ed?
Yeah, and sticking with Google, the search giant does plan to add conversational artificial intelligence features to its flagship search engine as the tech company responds to competition from chatbots such as ChatGPT. Sundar Pichai said advances in AI would supercharge Google's ability to answer an array of search queries. That was in an interview with the Wall Street Journal. Much more ahead. This is Bloomberg. After announcing some of the largest rounds of layoffs in their history, US big tech companies are now being reminded how difficult it is to reduce headcount in Europe, largely due to labour laws in countries like France and Germany. Bloomberg's Aggie Cantrell joins us from Germany. You were part of the reporting team on this. What it comes down to is labour protections, right? Why are Amazon and Alphabet in particular finding this so hard to enact?
Exactly. It's incredibly challenging in several European countries to do the sort of sweeping layoffs that we've seen in Silicon Valley, where we've seen people have to pack up their boxes within weeks or months of these announcements. That's not the case in Germany, where I said, or in France. And to look at Germany for a second, the reason is essentially there needs to be negotiations with works councils, with employee representatives from within the company to create a negotiation and create a settlement for the amount of employees that are leaving, the extent of the cuts, and also what sort of settlement they're likely to get. And in France, it's perhaps even more stringent than it is in Germany. And there we're seeing companies like Google offering voluntary departure schemes, and they're discussing essentially how to get people to leave by essentially buying them out of their jobs.
Yeah, they're having to get really generous, right? Can you talk us through some of the changes they make to entice senior managers to leave?
Yes, so essentially there are these discussions about giving senior managers very large packages in order to leave the company, which actually, notably, while not part of the same layoffs package, is also something we've heard at Meta with this idea of flattening their workforce. And that's something that Meta is proposing across the board. But what we're seeing in France is also based on an issue in France where it's not so easy to just let people go without cause, without them doing something that means that they should be fired from their job. It's not so simple just to let people go from these roles. And so these layoffs will come with a huge price tag for these companies. We've heard Alphabet already indicate that these layoffs could cost up to $2.3 billion globally. And while they've said that in the US, the brunt of those costs will be felt in Q1. And of course, let's remember, this is all about efficiency and being able to tighten the belt. While those costs are felt in Q1 this year in the US, that's not the case with places like France and Germany, where these negotiations are going.
Aggie, Amazon did not comment on the story. Google did, and they explained to us that in some markets, Romania, for example, Greece, they won't for now be cutting jobs. This is what they had to say. We're showing on the screen right now. Old school tech structure is what caught my eye, right? You have compromises around stock compensation and also bonuses. There are some clever workarounds that Google in particular and Amazon are trying to do. What are they?
Yes, so essentially these companies are looking at finding different ways in which to provide, for instance, stock options is a good example, to the departing workers, but also when you look at the broader structure around hiring in Europe, this is also a conversation around going forward, what it will look like to bring more people on board in these companies in these regions. And so, as you say, in some markets, they're not laying people off at all. That may also be a strategic point that the offices aren't actually that big in some of those markets. It's also about being able to have enough people on hand for dealing with the huge amount of content that is in various different languages around Europe. So while going forward, there are these question marks over the costs that this could bear for these companies. I don't think it really means that they're going to be pulling out of these markets or when it comes to hiring. They're likely to still be engaging with these workforces because countries like France and Germany are hugely important for Google, for instance.
Aggie Cantrell, thanks so much for staying late with us. We appreciate it. Meanwhile, let's turn to a stock we're watching. Samsung, heading for its lowest profit since the global financial crisis, if not longer. And it's due to a sharp slowdown in tech demand, of course. It's triggering losses in its semiconductor division. Now, the South Korean chipmaker reporting preliminary results for the March quarter tomorrow. It's expected to say operating profit plummeted some 90%. We'll continue to follow it. From New York, from San Francisco, this is Bloomberg.
All right, time for Talking Tech. First up, Binance. In a CFTC lawsuit against Binance over sham compliance with US derivatives regulations, 3 unidentified trading firms have been cited as VIP clients. They've now been named: Jane Street Group, Tower Research Capital, and Radix Trading. That's according to sources. The 3 US quant firms were cited anonymously by the CFTC in its lawsuit as examples of how US clients accessed the platform. An illicit online marketplace where users sold stolen passwords, bank account information, and other sensitive data was shut down by the US, UK, Dutch, and other law enforcement agencies. This week, authorities seized the site known as Genesis Market as part of an effort dubbed Operation Cookie Monster. The site began in 2018 and has offered access to data stolen from more than 1.5 million compromised computers, accounting for more than 80 million credentials that could be used to access accounts. That's according to the Department of Justice. Law enforcement arrested 119 people in connection with the site, that according to the European police agency Europol. And finally, converting the world to entirely clean energy will require $10 trillion worth of investment, but continuing to rely on fossil fuels would cost about $14 trillion. That according to Elon Musk. A massive build-out of solar panel factories and metal refineries are required over the next 20 years to deliver renewable power generation and electricity storage capacity, which will then be needed to power the global economy entirely with carbon-free energy. Tesla said in its master plan, Part 3, which was published today. The white paper fleshes out details of Musk's vision for a world without fossil fuels, first outlined, of course, during that Investor Day last month.
Let's stick with EVs, Ed, because Stellantis plans to manufacture an all-electric version of the popular Ram truck at a factory, of course, in the United States, we understand. It's all according to its CEO, Bloomberg's David Welch. I'm pleased to say is here in New York. But of course, the auto show that's going on, some of the summits. And talk to us about the Ram, the focus basically on making sure that they can access some of the Inflation Reduction Act offers to the consumer.
Yeah, thanks, Caroline. So just to get in the game with the Inflation Reduction Act, you've got to build the vehicle in the United States. And then beyond that, you've got to satisfy other requirements where the batteries are built, where the ingredients to the batteries are mined and processed to get the full $7,500. But just to get in the room, you have to build in the United States. So in that sense, I think the Inflation Reduction Action was a big incentive. It was a little bit up in the air in the sense that Carlos Tavares, who told us about this at the auto show yesterday, has complained greatly about the cost of building EVs, the lack of profitability, and we thought he has a pickup truck plant in Mexico. He could possibly build the vehicle down there and save on wages and that sort of thing. But he says it's coming to the U.S. Which plant exactly? TBD. He said in the next week or two we may know that.
Hey, David, in U.S., let's be honest, Stellantis is playing catch-up when it comes to electrification, right?
That's right. The companies that have really made a big commitment here, Volkswagen, General Motors, obviously Tesla's the leader, everybody's trying to catch them. Stellantis has been a little bit more conservative with this, as has Toyota. They see consumers still buying internal combustion vehicles in huge numbers. They don't see profits in electric vehicles yet, and they're thinking they can be a fast follower.
Just remind us of the scope of who the competition is. I'm thinking Ford, I'm thinking, what, even Rivian to an extent?
Ford's a big player, obviously. They've got the F-150 Lightning and the Mach-E out there. Rivian and some of the startups are. They're very legitimate players. However, their volumes right now are so small. I mean, Rivian's looking to make 50,000 vehicles. You know, General Motors is saying they're going to sell 50,000 just in the first half of this year, and they're just getting started. 100,000 next year. Tesla's already pushing 1 million globally. So some of these startups, they have good technology and desirable vehicles, but getting to critical mass, pretty tough for them.
All right, Bloomberg's David Welch, our Detroit bureau chief. Thank you. Sticking with autos and looking at shares of Tesla, the company actually tripled its workforce in Austin to more than 12,000. This was absolutely brilliant reporting from Bloomberg's Dana Hull, who did the Freedom of Information request, looked at the data for Travis County, and found that actually this has been rapid growth. Shares, though, softer by about 0.4%. But wow, good year so far for Tesla. This is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
And Ed, we're about halfway through the trading day, halfway through our show. Let's check in on basically the turnaround we've had since about 11:30, an hour ago. NASDAQ breaking into the green as we work towards what is going to be a holiday-shortened week. Maybe a little bit more risk appetite building into the system. We're still, of course, anticipating that all-important jobs data tomorrow morning. Two-year yield basically flat on the day, having been on the downside the last few trading days as money sought more safety. We're seeing Bitcoin again at that 28,000 level. We cannot break through it. Moving on to some of the micro moves, because basically, if you're going to see money moving into stocks, it's got to be AI related on the day when you're looking at technology. Alphabet shares, Google up 2.4%. Interesting what we see in terms of that reporting coming from the Wall Street Journal, that yes, we knew an AI chatbot was being developed over at Google, but they're likely to be starting to lace it in and maybe providing the impact within Google relatively swiftly. Alibaba, more certainty there. As soon as next week, we'll understand the unveiling perhaps of its own AI, generative AI chatbot, and what they have on the table in terms of China.
So a lot of this discussion is playing out on social media, right? You and I were in the news business. And I think right now we're really interested in knowing how our audience is getting their news. Aside from this program, Bloomberg Technology, of course. So we asked the question, do our daily poll, and here are the results. And I find them fascinating. Because social media, Elon Musk wants Twitter to be the go-to source of news. 63% of respondents are saying social media. Look down at Substack and newsletters. 12% of the vote, Caroline. You know, you think about what's happened this week, Chamath Palihapitiya, Social Cap, putting their performance note out there on Substack.
Yeah, more and more people deciding to go direct to their audience. I mean, let's face it, there's been a bit of a brain drain from media, people leaving to go and do their own direct-to-consumer provision through newsletters.
Yes.
But people are building them within media organizations, but also going to Substack to provide them just on a one-on-one basis.
Yeah, I think what's interesting as well with Substack is that, you know, it's you yourself putting it out there on a platform, much like it is on social media. So let's talk about it, because Substack is actually inviting some of its contributors to become investors. The newsletter publisher tapping more money from less wealthy investors by letting its authors and subscribers put in as little as $100 for shares in an effort to keep growing in what is a tough market for fundraising. Delighted to say, Caroline, Substack CEO Chris Bess joins us now. Chris, is the motivation here that you need money for Substack, or you're thinking about audience development?
The main motivation here is we've been building this subscription network. This year, we've seen it really start to take off. We've seen the power of the network kick in. We've seen people growing from, as more and more people join the platform, the people who join are creating a lot of the value. And we wanted to create an opportunity for them to become investors.
Caroline, I think the other thing that we're conscious of here is the reputation of the people that are posting through Substack. Right? I mentioned Social Capital and Chamath Palihapitiya. They made an active choice to put their annual performance of their fund on Substack rather than other methods.
Yeah, Chris, clearly you're winning subscribers, writers as well. What is it, 35 million active subscribers? I'm interested in, therefore, what's the uptake? How many have said, yeah, we want to not only write for you or consume via you, but invest in you too?
Honestly, we've been blown away by the response so far. I actually can't talk about it too much here. You have to go to the WeFunder page to look at what's there. But we've been very pleasantly surprised by both, you know, the sort of quantity of the response and also just the tenor of it. We've had a lot of people come out and talk about why they believe in Substack, why they think this thing is important for the world. I loved seeing that 12% graphic at the start of the thing, the 12 smartest percent. It feels like this thing is really going.
But what about
we've been blown away.
The questions that are being asked of you, though, Chris? More transparency. There's always, I mean, I've been there reporting on when the bond market started to open up to retail investors in the UK, and everyone said, well, it's because they can get money more cheaply. Basically, people, the investor, isn't as institutionalized and therefore doesn't ask some of the more nuanced questions. What are you saying in terms of, I want to know your costs, I want to know your revenue at Substack?
Totally. And, you know, the fact of the matter is Substack is a private company in a very competitive market. And a lot of the writers, the people on Substack, are not just members of the public, but a lot of them are reporters themselves. A lot of them are people that cover the industry. And so we've had to think of everything we release as becoming public. So we've been pretty thoughtful about how we've done that. We've been, you know, stuck to releasing everything that we need to release as part of the Reg CF. Other than that, you know, we haven't shared a ton. And the pitch that I've been making to people is really like, hey, investing in startups in general, any startup, even a great startup like Substack, is a risky proposition. You can lose your whole investment. It's not a thing to do sort of lightly or with money that you don't want to make up. I've been giving a little bit of a kind of an anti-sell for folks on that front. I want people to come if it's something that they want to be a part of, if it's something that they're seeing the benefits of and they believe in.
Yes.
We're not trying to make it. It's not.
Yeah.
It's not. It's not an appeal. I'm not trying to be Bernie Sanders here, saying, please give us your money. This is an opportunity to be part of this thing if you want to.
Well, Chris, look, an investor's risk appetite is often driven by data. There is some data out there. Reportedly, you did $9 million of revenue in 2021. How did you do in 2022?
Better, but I won't talk about it.
Oh, come on. Give us a sense of size of scope. You're trying to appeal to investors here, and you talked about the need to be transparent, have public-facing data. Just explain to us the health of the business. How did it grow in 2022? We've gone over the numbers about growth on the subscriber base. How did that translate to performance for the business?
So we had about 35 million active subscriptions now. We're at 2 million paid subscriptions, and the top 10 publishers on Substack combined to make $25 million a year. Those are the numbers we're sharing.
If you could have raised through VC, Chris, would you have done? Sorry, I missed that.
Go ahead.
Yeah, would you have fundraised through venture capital if it had been there last year, this year? I mean, I know that you're saying this is sort of this perfect way of building your momentum, getting people to come on board and invest. But if venture capital was still awash with cash, if we hadn't had interest rates rise, would you have raised with VC if the money had been there and the checks were easier to be written?
I understand. The way that we've been thinking about this is we have sort of tuned the business not to rely on outside capital, given the state of the market. So we're in a place where we have a path to doing the mission we set out to do, kind of regardless of what's going on in the market, whether there's further outside investment, any of those things. The way that I look at this is we can be a little bit, work with the situation that exists in the market. If there's opportunities to get more money on favorable terms, I think there's ways that we could use that to accelerate. But also, we don't need it. I mean, this is a business that fundamentally works, and we have a path to building it with what we have.
Chris, we started this segment talking about where people are going for their news. Us, Bloomberg Technology, social media, Substack. I think you're working on Substack Notes, which to many seems to be an attempt to offer something similar to Twitter.
The way I think of this is that I think the era of the social network, as we know it, is ending. I think that a lot of the online media platforms, the Twitters, the Facebooks, the Instagrams, are sort of pulling in this one direction, right? The ad-supported business model is kind of forcing everyone to turn into TikTok that's in that world. And I think it creates this huge opportunity in a different direction that's not about kind of like grabbing eyeballs and attention at all costs, but instead is about making things that people deeply value, letting people connect to things they trust. So I think all of online media is basically either going to have to turn into TikTok or it's going to have to turn into Substack in the next little bit. And Substack Notes is sort of our play to bring the easy sort of sharing, the short form, the ability to recommend anything to the subscription network that is Substack. And we're tremendously excited about it. Substack
CEO Chris Best, thanks for joining us. Meanwhile, coming up, could some American investors be funding China's answer to OpenAI? We'll have more on that pretty heated debate that's playing out all over the likes of Twitter with Lightship Capital partner Brian Rakim. And we're also talking about Savvy Games Group, part of the Saudi government's public investment fund. It's agreed to acquire game publisher Scopely for almost $5 billion, the company said yesterday in a statement. California-based Scopely publishes free-to-play social games and has raised money multiple times over the years. It's actually often grown through acquisitions. From New York, from San Francisco, this is Bloomberg. Some breaking news. President Biden, his administration, is going to propose the toughest ever auto emissions rules, basically to spur demand for electric vehicles. This has been something that the pressure is on not only from the US, but geopolitically. Ed, you are our EV expert, certainly on this show, if not for the entire network. Talk to us a little bit about why we're seeing this sudden focus on EVs in particular.
Yeah, the reporting here is really important. Biden is stopping short of an outright ban on production of gas-powered vehicles, but toughening the mandates. You have to remember that under the Paris Climate Agreement, the United States has to cut its greenhouse gas emissions from 2005 levels by 50% from the end of the decade. Joe Biden also has a personal goal to have 50% of all new cars be electric by 2030. So this is him acting on. We believe from sources that the announcement will come formally next Wednesday after the long weekend, but clearly some action here.
And coming from Detroit, meanwhile, all the automakers are basically here in New York, and we've heard of all the supply coming in terms of EVs, but it's difficult, isn't it? Basically, Tesla's already there in terms of production, but it's taken some time for some of the legacy makers.
Yeah, competing forces depending on who you are, right? If you're a legacy automaker in Detroit and you're transitioning from combustion engine to EV, what we know is those OEMs have asked the administration for more time, an extension of the requirement deadlines. Your Tesla, it's the opposite. You're like, hey, we're already in the game here. Be tougher. And that's what Tesla, I'm sure, in the corridors of the White House has been calling for.
Certainly some geopolitics at play when it comes to the Biden administration. In fact, there's geopolitics at play in general when it comes to AI as well, Ed. We're going to dig into that now because there's basically a bit of an arms race going on, isn't there, between the US and China, and it seems to be gaining momentum. That's after OpenAI's ChatGPT really has taken the world by storm last year. Now venture capitalists are starting to raise some concerns that US investors, US money and venture capital could be backing China's best hopes in the field in terms of a competitor. Now, the debate is playing out all over Twitter after the Information reported yesterday that institutional investors from America are backing Chinese-based venture firms with dollars to put into China's top AI startups. Brian Brackeen, he's general partners over at Lightship Capital. He's one of the VCs that's been taking part in that very debate. You're joining us now, Brian. Great to have you. And so tell us, are you concerned or not concerned by some of this hyperbole?
I am ringing the alarm over it. AI requires, the AI arms ratio, as you described it, requires capital. It's a very expensive endeavor. And so for the idea that a venture capital firm would take money from investors in the US, send it to China to build a product that could be used against US interests makes zero sense.
Okay, demystify from that perspective, therefore, whether the money should be being pulled back from privately positioned businesses, but also we were just talking about how Alibaba, for example, is set to, as soon as next week, unveil its own competitor to ChatGPT. I look at who the biggest shareholders are of Alibaba, and, well, on the American Depository Receipt perspective, it's Goldman. There's Morgan Stanley in there. Should they all be giving up on backing some of these public companies?
I think in general, there's opportunity in other markets. Understood, it's capitalism, we agree with that. But there are certain technologies, for instance, if Intel makes chips that can be used in North Korean missiles, we don't allow that in the US. This is exactly the same. US capital and also US know-how shouldn't be used in creating these AI tools, because after you make an investment, you actually have a responsibility to make sure that company is successful. And therefore, you're helping to make sure that China is successful.
Ed, it's interesting that certain names within the VC community were highlighted by this Information piece in particular, because they have venture arms in China. One of them really spoke out on Twitter.
Yeah, and the idea here is that Sequoia has come out, one of their partners on Twitter, I think we'll show it on the screen now, and said Sequoia China and Sequoia are different. The headline was misleading. Brian, let's go back to the point. Investors have been going to China tech for a long time. This is specifically an anxiety coming around artificial intelligence, right? Why? Why is AI so problematic?
Well, I'll answer both things. On the different arms piece, when Sequoia is out raising money in China, they're saying, we're Sequoia, we're the brand, we know what we're doing, we can build the best companies. That's why you're going to give money to either arm. So though they may be legally separate entities, it is literally one strategy to create the world's most successful companies. And in this case, that's an issue. And to the second point, like, why is this so dangerous? I often describe AI as like dog years, right? So it's not aging year by year. Every year is 3 or 5 or 7 years. And so only a couple of years from now, what they're creating could be used to create a surveillance state, not just there, but also here.
Brian, you are an AI expert. You consider yourself an AI expert. I think your prior successes include the sale of an AI company you founded. Are you worried that this is just the threat of competition from China outdoing what's happening in the United States?
That's certainly true. But the way that Chinese companies go about the AI space is different. I remember when I started my company, Kairos, we had the number one source of attacks were from China. Number two source of the attacks were from Russia. Constantly trying to get access to the data so they could then use that in their own uses. They just don't have the same approach toward the morality around these technologies that we do in the U.S.
In fact, we've seen some issues with the morality, the ethics, the speed of development here in the US itself as well. That open letter coming from hundreds of signatories wanting a pause on AI development here in the United States. Brian, from your perspective, therefore, is the US at risk of losing this battle versus the Chinese? And what more do you want put in place from a federal level even?
I think it's a good point there. Our house and our hands are not clean either in the world of AI. We can do better. We can be better. But there is a process and a system that can allow for an improved AI. And we're having those conversations now with morality leading the goal. Oftentimes in China, these are not conversations, or they're conversations held in back rooms. And I think that's one of the challenges.
What about the reverse? I know that we have CFIUS in this country, but are you against, say, Saudi money or Chinese money coming in and investing in the AI field for US-based startups?
No, I'm completely inconsistent on this matter. I'm happy to take those dollars here and to use those, into our framework. That said, I wouldn't want those technologies to be exported back to Saudi or back to China and used for human rights violations.
From your perspective, Brian, what stops this? Because in many ways, if you're seeing it from a negative perspective, US money going to China, you're already saying, look, Pandora's box has been opened. People went out there, did joint ventures with China, because at that point, everyone was trying to build a more global and globalized state of capitalism. How do you unwind that?
Yeah, I think China's evolved over time, as has the American position. I think you're seeing both on the right and the left real concerns around TikTok and other platforms. The genie is out of the bottle, certainly. But in this case, it's not too late to put it back in. Regulation can put us where we need to be if we have the strength to put it in place.
Lightship Capital partner Brian Brackeen, thanks for joining us on the debate. It's going to rumble on, I think. Meanwhile, coming up, after the Future of Life Institute's letter, we were just talking about it, calling for the halt to AI development, what is the real threat of generative AI? Is it really about developing, quote, more powerful digital minds, or something else entirely? We'll discuss that next. This is Bloomberg.
The impact on jobs is real, but it doesn't have a super intelligence that will have a mind of its own. It really just predicts the next word because that's what you're asking it to do.
U.com CEO Richard Socher there, talking about how basically apocalyptic scenarios around AI, pretty unlikely, which is just the subject of Bloomberg Business Week's piece today, about how the real risk of AI development might be more, closely linked to disinformation. Bloomberg Business Week's Max Chafkin, I'm pleased to say, is joining us to run through this hype around the intelligence part of artificial intelligence. Seems to be a little bit making it more of the hype cycle. What are the real issues, do you think?
Yeah, so it's kind of telling that many of the people who are most worried about these technologies are also the people who are selling these technologies. And you can kind of see why, because if you're trying to sell something, it's very useful to say this might be too powerful, might be too scary. Now, that's maybe a cynical way to look at it, but as this piece points out, I think the kind of conversation around AI overlooks the issue of misinformation, which I would argue, and I think many others argue, is the real concern. So we're not talking about super intelligence taking over, turning us all into paper clips. We're talking about our social media, our search engines, basically all of our information consumption being flooded with garbage or stuff that kind of looks real but not real. So you think about junky search results, junk, fake stuff on social media. That's the sort of thing.
Max, Caroline and I have had signatories to the petition on the show, and they don't even agree that a 6-month pause would work. Is there anything that they do agree on? Whether they were a signatory or not?
No, I mean, I think that what's interesting about the petition is it brings together a lot of different voices, some of whom are more, would more express the critique that I'm expressing, and others who are expressing this apocalyptic thing. And that's one of the reasons why I'm not sure this letter has been particularly useful or will change a whole lot. That said, there is a possibility of regulation. I mean, there are hints of that, coming from the U.S. government. You could imagine a situation, not where the U.S. government is worried about takeover, but something smaller.
It's got us all talking about it either way. Bloomberg Business Week's Mac Chafkin, thank you. That does it for this edition of Bloomberg Technology, Caroline.
Yeah, shortened week. We're off tomorrow. Go have a relaxing time if you're not working too. Don't forget to check out our podcast, though, if you've got a few minutes to spare. You can find it on the terminal as well as online on Apple, Spotify and iHeart. From New York, from San Francisco, this is Bloomberg.